Hi everyone. So in today's video, what I want to talk about is why you should avoid setting up too many limited companies. As an accountant, I come across this a lot, like business owners where they start up a new company every time they have an idea. And it's not always a wrong thing to do, but what I want to cover in this video is the disadvantages of having too many companies, and also the thought process you should go through when deciding whether or not to set up a new company or trade through your existing businesses. Okay, let's talk about the advantages. Firstly, people love setting up companies until they see the accounting bill at the year end when they've got a... So there is an additional cost to looking after all these other companies, but it's not just accounting costs. It's the setup costs, because there was a time a few years back you could set up a company for about £13 at a company's house. Now that's actually gone up to about 50, so there's costs in setting it up. There are costs involved in all the insurances that you need to run it, and then there's all the other elements like accounting services and whatever else, including banking as well, really. One of the points why you don't want to necessarily do it is the cost. There will be, even when you have a good accountant, there will still be a little bit more work involved in managing it all. And probably the joint first reason with the cost is what's happened now is there was a few years ago, the government increased the corporation tax rate from 19% to potentially 25%, depending on how much profit your business made. So the idea was if you made less than 50 grand a year, you'd pay 19%. If you made more than 250 a year, you'd pay 25%. And if you made somewhere in the middle of that, you pay somewhere in the middle of 19 and 25%. What happened though is, so people couldn't just set up loads of companies and they'd just make 50k profit in each one and not pay the high rate of tax. The government brought in the associated company rule. So what that means is if you've got one company and you make 50 grand or less, you pay 19% corporation tax. However, if you've got two companies and they're what you call associated companies, because they've got common ownership or common control, then actually those allowances get split. So if you've got two companies, that means each one can only make £25,000 before the corporation tax rate starts going up. So actually, depending on your setup, you could end up in a position where actually your corporation tax rate increases quite drastically or quite substantially, just because you've got all these other companies. So yeah, realistically, the three main reasons why you don't want to necessarily set up too many companies are the cost involved, the time involved, and the fact that you could increase your corporation tax rate. So now we'll discuss that. Let's talk about reasons why you may want additional companies and the thought process you should go through when deciding whether or not to have additional companies. So why do people split out companies? The right reasons are because they want to separate risk. If you're about to do something quite risky and you don't want to do it through your current business, because if it goes wrong, you don't want your current business to be affected by all the creditors that are linked to this new thing, then that's a valid reason. Another reason you might want to set it up is you might be setting up a new business where you're selling to consumers and you don't want to be VAT registered. Your old business might be selling to businesses that were VAT registered, so it didn't matter if you were VAT registered. In fact, it was preferable because then you could recover VAT on your costs and your customers wouldn't care if you charged it to them. But your new venture, if you don't want to be VAT registered for that because your customers can't necessarily reclaim it or won't pay it, then actually it can make sense to run it through a new venture. So those are the two main ones. Or another company is if you've got a mix of partners. Let's say you're doing something through your main company, but you want to set up another venture where you've got a business partner in that other venture. You don't want to give them access or any shares in your main company or your original company, then it might make sense to set up another company to do that. So there are like really three reasons. One is the VAT side of it. The other is the risk side of it. And then the third is the partnership side of it. So you can actually separate out activities. I would say bad reasons to set up another company are if you're just worried about a trading name. If you've got an existing company, something enterprises, like it can have a trading name, like any trading name that you want, as long as it's not trademarked, obviously. Setting up another company just because you want it to be called something isn't necessarily the best reason to do it. You'd be better off just setting up a trading name and having that trading name operate under one of your existing companies. So next time you're thinking of setting up a company, talk yourself through that decision-making process and think about the cons and decide whether or not you really want that new company. And if you do, then go ahead and do it. And if you realize actually that there are some side effects that aren't desirable, then don't do it. And I'll see you in the next video.